Welcome to the debate from GiltEdge.uk. Before we begin, this content is for informational purposes only and does not constitute financial advice. Always do your own research and consider seeking independent financial advice before making any investment decisions. Your capital is at risk. Today, The Guardian and The Challenger go head-to-head on Lock In Now, why a fixed-rate mortgage is the only sane choice before Thursday's MPC decision. Let's get into it.
With the MPC meeting on Thursday, swap rates at their highest since October, and 472 mortgage products pulled from the market in the last 48 hours, if you're remortgaging or buying in the next 6 months, you need to fix now, not because fixed rates are cheap, but because the cost of being wrong on a tracker is catastrophic.
The base rate is 3.75%. The best trackers charge base plus 0.19%, giving you 3.94%. The best 2-year fix has just breached 5%. You're asking people to pay over a full percentage point more per month for the privilege of certainty that's handing your lender free money.
A full percentage point that buys you insurance against a world where US tariffs have thrown global trade into chaos and nobody, not the Bank of England, not the markets, knows where inflation lands in 6 months.
But the MPC is still cutting. They've cut 3 times since August. The direction of travel is down, not up.
The direction of travel was down. Past tense. Swap rates have reversed sharply, and lenders don't pull 472 products in 2 days because they think rates are falling.
Lenders pull products to reprice and protect margins. It's not a signal about where rates are going, it's a signal about where lender profit targets are. They did exactly the same thing in 2023 and rates came down within months.
And between those months, tracker customers watched their payments spike by hundreds of pounds. That's the point, even if rates eventually fall, the volatility on the way there can break a household budget.
Sure, but look at the actual history. Research consistently shows tracker borrowers pay less than fixed-rate borrowers over almost every 5-year period going back decades. The maths favor the tracker, they almost always do.
Historical averages don't pay your mortgage when there's a 1 in 10 shock. We're living through one right now, a global tariff war that didn't exist in any of those historical datasets.
Every generation thinks its shock is unprecedented. People said the same thing during Brexit, during COVID, during the mini-budget. Each time, trackers still came out ahead over the full term.
The mini-budget is exactly my point. Trackers went from comfortable to terrifying in about 72 hours. Real families couldn't make their payments. A fixed rate is the only product that guarantees you can.
Except the people who fixed at 6% in October 2022 are still locked into those rates right now, paying thousands more than they would on a tracker. The fix didn't protect them, it trapped them.
Because they didn't have early repayment options. That's a product choice problem, not a fixed versus tracker problem. You can fix with reasonable ERCs and still have an exit.
Reasonable ERCs still cost 1 to 3% of the outstanding balance. That's thousands of pounds. And you're ignoring the higher arrangement fees on fixed products and the broker commission incentive to push you toward them.
The broker commission argument is a conspiracy theory dressed up as financial advice. Brokers recommend fixed rates because their compliance teams know that if a client can't afford a rate rise, the broker is liable.
It's not a conspiracy, it's a financial incentive. Fixed products do generate more commission on average. I'm not saying brokers are corrupt, I'm saying incentives matter and borrowers should know about them.
Fair enough. But let's get back to the actual decision. You're on a tracker at 3.94%. If the base rate goes up just 0.5%, which is entirely plausible given tariff-driven inflation, you're already at 4.44% and climbing, with no ceiling.
And if the base rate drops 0.5%, which is what the futures market was pricing in before the tariff noise, I'm at 3.44% and saving over £150 a month compared to your 5% fix on a typical £250,000 mortgage.
The futures market has repriced dramatically. That's the whole point. The certainty you're banking on doesn't exist anymore.
Neither does yours, you're paying a premium today for a prediction about tomorrow. The difference is I'm paying less while we wait to find out.
You're paying less until you're suddenly paying a lot more, with no warning and no protection. That asymmetry is the entire case for fixing.
I'll grant you this: if someone has stretched to the absolute limit of their affordability, with no savings buffer, then yes, a fix makes sense. That's risk management for people who genuinely cannot absorb any payment increase.
Thank you. And that's most first-time buyers and a huge number of remortgagers right now.
But it's not everyone. If you've got equity, savings, and a mortgage that's a reasonable multiple of your income, you're paying a fair premium that the data says you'll regret. Over 2 years at 5% versus a tracker at 3.94%, that's roughly £2,600 in extra interest on a £250,000 mortgage before rates even move.
£2,600 is cheap insurance when the downside scenario is your payments jumping 30 or 40% in a rate shock.
A 30 to 40% jump would require the base rate to hit 5.5% or higher. Not even the most hawkish forecaster is predicting that.
Nobody predicted Liz Truss either. The point of insurance is that you buy it before you need it, not after.
And the point of good financial decisions is not overpaying for insurance you're statistically unlikely to need. Most people will be better off on a tracker, the numbers are clear on that.
In a world this uncertain, being able to budget with absolute certainty for the next 2 to 5 years isn't overpaying, it's the only sane choice before Thursday.
If certainty is what you're buying, at least be honest about the price, because right now, your lender is the one sleeping well at night, not you.
The Guardian, The Challenger, thank you both. What do you think? Let us know in the comments. Read both articles in full at gilt-edge.uk. Thanks for listening to the debate.